Hello, everyone, and a warm welcome to today's webinar on market insights for fixed income. Since our last interaction, there has been considerable activity in the markets, right from the Fed's FOMC updates to RBI's Monetary Policy Committee's decision, and more recently, rising concerns around the global tariff changes. Today, we will explore the key trends and the emerging opportunities shaping the fixed income landscape. I'm Sandeep Solanki, product specialist, and I'm pleased to join by Mr. Anurag Mittal, our head of fixed income. He will walk us through the current market dynamics and share insights on the fixed income markets. Following Anurag's presentation, we will open the floor for Q&A session. You are welcome to submit your questions anytime throughout the link provided during the webinar. So without further ado, let's get started. Anurag, over to you.
Thanks, Sandeep, and good day to everyone, and thanks for joining in on our fixed income webinar. We'll be starting with key global trends and how they are shaping our domestic policy outcomes as well on the RBI policy and what kind of portfolio strategies make sense in the current environment. So we'll start with the global trends first. So if we look at, in the last 6 months, there was a lot of revival in the manufacturing activity. And as we can see now, slowly for the last 2 months, the manufacturing has started to slow down. Our sense is that probably a lot of pickup in manufacturing activity, uh, especially from January 2025 to March 2025, was in anticipation of Trump tariffs during April, which he termed as Liberation Day. So a lot of front loading of imports into the US happened, and that is why there was a lot of manufacturing which took place from the usual exporters such as China, South Korea, Taiwan, India, etc. And as that exports took place, tariffs have been announced, they have been implemented, and we are seeing some slowdown in manufacturing, as you can see on the blue line on the left-hand side of the slide. If you look at the amber line at the same time, the services PMI continues to be quite robust. We are seeing the second round impact of the strong manufacturing that we saw during the first half of the year. So all that, higher production, accompanying rising employment, accompanying rising wages, is helping overall, building the demand for services. So broadly, the gap between manufacturing and services, which started to really widen post 2023, uh, still continues, where services-led economy, they continue to do well, and manufacturing cycles are getting shorter, they are getting more, I would say, steeper and sharper, and probably we may see some slowdown in manufacturing in coming months as well, till we again get more clarity on tariffs, and hence pick up in economic activity. On the right hand side chart, which shows US manufacturers inventories to shipment ratios, and if you look at the dotted line, that shows the pre-COVID 2019 average. And as you can see, we saw a large, buildup of inventory during 2024 and 25, probably in anticipation of tariffs. And especially if you look at durable goods, that is trading or keeping well above their, historical average compared to non-durable goods. So we still expect manufacturing to remain muted in the coming months as this inventory runs down back to the average levels, and then that is when probably we reassess. That is when exporters will really look to further get more inroads into the manufacturing. But at least for the next couple of months, we expect manufacturing activity to remain on the weaker side. Like we said in the beginning, there was a lot of activity globally. In fact, when the year started, the market was talking of US exceptionalism. And what it really meant, in the beginning of US exceptionalism was that the new administration will bring deregulation. Probably it will not be able to sign trade related deals with various nations. So there will probably not be any tariff related restrictions on the global economy. and there will be tax cuts. So overall, when the U.S. exceptionalism was thought about, it was thought that probably U.S. will continue to grow at a much faster pace than the rest of the world. Of course, then the Liberation Day happened. U.S. announced quite steep tariffs on most of the major economies, and they had to go in for a pause for 3 months, which kind of gets an effect from today. And again, there was anticipation that probably, given that difficulties in signing deal with every economy, probably US will not be able to make deals with every economy, and there will be a lot of uncertainty with the businesses. But July was probably a month where US did do a lot of deals. These are largely framework agreements, so they should not be confused with trade deals, where trade deal there are a lot of other details, goods by goods, which is mentioned. There are also dispute resolution mechanisms. Those are also ratified by the respective parliaments of various countries. So they are largely framework agreements which have been finalized between the US and the trade delegations of major economies. But it removes a lot of uncertainty from for manufacturers as well as importers for the US from these countries, that they know that these are largely the contours of the deals which have been agreed, and they can start their economic activity going forward. So if you look at the left hand side chart, and it shows in the red bar the countries against which the framework agreements have been finalized. We can see that UK, Europe, Japan, Indonesia, Philippines, and most importantly China, where largely the contours have been agreed and finalized. China is still work in progress, but for now, market expectation is that the final tariffs will be close to the current tariff agreed of 30%. Whereas if you can see on the gray lines, these are the countries where uh, the new administration has put in tariffs, but these are not yet finalized. For example, Brazil has been a unilateral um, invocation of 50% tariff, on Switzerland 39%, for example, in India, the 25% baseline tariff, which um, which is still being negotiated, and a deal is yet to be finalized. But largely, economic uncertainty has eased as the US has concluded agreements with major economies. And if you look at the right hand side chart, which tracks the US effective tariff rate, which was just 2.7%, in January 25, which went all the way till 25% in April 25, as a result of climb down on many of the original tariff rates announced in April. Now the effective tariff rate for the US stands at about 15%, which is definitely on the higher side compared, if you look at the January numbers, but it's much more manageable than what we saw in April. So broadly, overall, it's been a positive month for global trade activity, where there has uh, given these kind of framework agreements. Now investors, now manufacturers and importers broadly know what to expect from this US administration. The other notable, thing which happened in the U.S. was passing of the One Big Beautiful Bill, as President Trump called it, which was the appropriations bill for the next year. Uh, there was a lot of uncertainty whether the bill would have been passed, because the bill was pushing for tax cuts and extension of the earlier Trump tax cuts for both individuals and corporates, which were enacted in 2016. Uh, so there was a lot of back and forth between both parties, and finally the bill was passed. So as you can see on the chart, there is a tax cut extension which should cost US about $4.5 trillion as per the congressional budget estimates. If you look at the defense spending, US also agreed to spend about 150 billion over a period of next 10 years to ramp up its defense capacity. And the same way, about 130 billion or was agreed for border enforcement. If you look at where the savings are coming from, while the savings are not of the similar magnitude of tax cuts, but the savings are quite significant as well. Medicaid savings have been estimated around $930 billion over the period of 10 years. Largely, eligibility has been changed. So many working individuals or many able-bodied individuals who were earlier eligible to get Medicaid have now been left out. State uh, involvement in medical administration has been increased, and many NGOs such as Planned Parenthood and etc. have been now excluded from medical benefit. So that broadly will result in about 900 billion odd savings from medical cost. The new administration has also reduced funding towards green energy, which should result in saving about $500 billion. And even on the food stamps or the SNAP, which is called, which basically provides for some budgetary benefit to lower income households to enable them to purchase food items. That also there the eligibility has been reduced. States administration has been increased because some cost has been pushed onto states. So broadly, there also the US expects about 300 billion benefit. But broadly, in a nutshell, which if you look at on the right hand side of the slide, which kind of reflects the deficit going forward all the way till 2034 as per budgetary estimates as well as other economist estimates. Despite higher tariff revenues compared to what the US was earning, before 2025, US is still likely to print somewhere close to 6.2 to 6.5% of fiscal deficit. So that is still on the higher side because if you remember before COVID, US used to run an average deficit of about 3.5. So the current numbers are almost double of the fiscal deficit that US used to run. So broadly, if that's the kind of deficit that US is expected to run for the next 10 years, and inflation is expected to remain even stable, it broadly should result in higher term premia, and hence the gap between the US 2 year to US 10 year or the US 30 year should widen further given the expected increase in supply of US bonds compared to the stable demand that we have typically seen. Because ultimately, what the new administration is trying to do, it's trying to reduce exports uh, from major economies to the US, uh, which so the currently what is happening is those exports generate a lot of savings for the exporting economies such as India, China, Japan, which in turn get invested into US treasuries. As those exports reduce, the income for many of these exporting nations reduce, and at the same time US debt supply increases. Uh, that will kind of create a cocktail of lower savings globally as well as higher domestic duration supply, which should result in a steeper yield curve, even if we assume inflation to stabilize from current levels. If you look at commodity prices declined in July 2025, largely driven by sharp fall in industrial metals such as aluminum, copper, etc. So earlier, when the expectation was that the administration will levy high tariffs on industrial metals, that led to a rally during the month, especially for copper and aluminum. But as the administration gave exemptions for many of these metals, the prices of these metals fell, which led to commodity index going down. Crude went up by 7% during the month of July, as the administration talked about putting sanctions on Russian oil exports. So, as we have seen for India as well, the US administration is recommending restricting Russian oil exports, and that's largely led to increase in oil prices across the world. As if that supply were to reduce for rest of the world, of course, it may lead to higher oil prices in the near term. Global food prices, although from a month-on-month perspective, they remain stable, but from a YOY, because of the base effect, they rose about 5.8% on higher vegetable oil and meat prices. If you look at the bond yields across major economies, they rose. If you look at the US, they rose from 423 odd to 437. If you look at Germany, 261 to 270. Brazil, of course, we saw a big pickup from 13.5 to 14%. But largely the uptick in yield was secular. The reason was stronger than expected economic data, like I explained earlier. when the Liberation Day tariffs were announced, many economist commentators, many market participants were expecting slowdown in activity. But as we have seen in the last 3 months, because of the pause given in tariffs by President Trump, the activity has remained quite reasonably high, and that's led to slightly higher inflation than expected as well, which led to many market participants pushing back against expectations of earlier rate cuts. So as those expectations of rate cuts also got pushed back, we saw the rise in bond yields for most of the major economies. If you look at financial conditions, so financial conditions in the US has remained largely tight as rate cut expectations they got pushed back, like I explained earlier. If you look at on the right hand side, which is the market implied policy rate forecast, so from 3.9%, now the policy rate forecast 1 year ahead was close to 4%. So market at the end of July was not expecting too many rate cuts from the Federal Reserve because of these tariff related inflationary adjustments. But on the other hand, if you look at the financial conditions index, there are three parts to it. One is fixed income, pure rates, one is equity, and the third is credit spreads. So if you look at the other two components of financial conditions, which is credit spreads and equities, they remain quite healthy, quite robust during the year, as well as during the month of July. And that would really led to financial conditions remaining largely stable. Now coming to India, and most importantly, the RBI policy which happened yesterday. So, before the RBI policy, especially on the back of the trade negotiations which were happening between India and the US, and we were also seeing some slowdown in urban consumption in India, the market expectations from the RBI policy were that probably RBI will maintain a dovish pause. So while market was not expecting rate cuts from this policy, but they were expecting RBI to acknowledge the slowdown in growth. They were expecting RBI to acknowledge the near-term sharp disinflation that we are seeing. For example, if you can see on the inflation estimates which have been shared, largely market, from a inflation of 3.7%, RBI revised the inflation estimates from 3.7% to 3.1% in FY26. So broadly, given the sharp fall in inflation estimates, market was expecting RBI to probably indicate rate cuts going ahead if the inflation conditions were to hold true. But RBI's language was slightly cautious than market expectation. RBI continued to focus on forward-looking inflation indicators, and if you look at where RBI is expecting inflation, largely it is expecting 4.4% inflation in the fourth quarter for FY26 and 4.9% inflation in Q1 of FY27. Given these forecasts by RBI, and if you look at the current policy rate, a 5.5% policy rate when the inflation forecast is 4.9, even if those inflation forecasts were to get revised downwards, that indicates a very limited scope for easing rates. And that really disappointed the market. Even on the growth side, if you look at, RBI retained their 6.5% growth forecast for, FY26 and maintained a growth forecast of 6.6 for Q1 FY27. And although it remains below the aspirational target of 7% that RBI talks about, but largely given the uncertainty on global growth, given the uncertainty of trade negotiations between India and the US, market took it as a strong RBI's confidence on domestic growth drivers, and hence the expectations of any further rate cuts from the RBI were reduced, which led to some profit booking, and yields went up across the curve. We saw uptick in the money market rates, government bond rates, as well as OIS curve, which reduced its rate cut expectations from RBI going forward. While market was disappointed from RBI policy, we at UTI have been expecting RBI to hold policy rates for a longer period. That is, we expect lower for longer policy from the RBI, given that inflation is expected to remain quite stable and growth probably is facing some downside risk from global growth activity, and hence we expect that while RBI may not be able to cut aggressively from here on, they might be able to maintain these rates for an extended period of time to ensure that growth comes back to the trend level that RBI has been expecting. If you look at the inflation trajectory, like we were mentioning in the previous slide, the inflation forecast have been revised, and now RBI expects inflation, of about 4.4% in Q4 of FY26 and 4.9%, which broadly led to some market disappointment as market was expecting slightly lower inflation given the weak food price momentum we are facing right now. We still think that these inflation forecasts are slightly conservative, and they can be revised downwards as growth momentum slows down. Even if you look at core inflation, excluding precious metals such as gold, silver, it has been quite well behaved and remained below 4% for a long period of time right now. We should expect it to moderate going ahead as well as urban demand remains quite weak, and as urban demand remains weak, it reduces the incentive for private sector investment as well, and we are seeing a lackluster private investment despite easy liquidity and lower rates. And hence, we do expect that once food prices stabilize, overall inflation should come down given the slack in the economy. We are also seeing active negotiations between India and the US government on various trade issues. Just yesterday, India was given a penalty of 25% on top of the earlier 25% tariff, which India was subjected to. So if you look at the current tariff rate, so of course there are some items like pharmaceuticals, and some metals which have been exempted from these 25 plus 25% tariffs. The overall effective tariff rate for India from 27th August, when these tariffs become effective, becomes 36% almost. So if you look at where India started with 2.7% as it is start of 2025. It went to 11.6 post the Liberation Day, but post the 25% tariffs, it goes 20.6 post of 8th of August, and post 27th of August, if there is no new deal between India and the US, the tariffs for India for for India over Asia even higher than China. So the first impact of these high tariffs, if they were not reduced, is reduction in growth. Broadly, India exports about 85 odd billion dollars to the US, and if we see slowdown in the exports there, especially on the gems and jewelry and textile side, we could see a drop of about 0.3 to 0.5% depending on the tariff rates and the exemptions given to India. But that's the first round impact. The second round impact, because of job losses and closure of businesses, could even be on the higher side. So probably RBI will remain in wait and watch mode. They will see whether how these negotiations take place, and probably if the tariffs were to remain, that may lead to some recalibration by RBI. The second aspect of these tariff negotiations is that if India were to reduce its supply of crude from Russia, uh, while India should be able to procure its supply, but given that India buys about 1.5 million barrels of crude from Russia on a daily basis, at least till mid of July, uh, it could lead to some spike in oil prices globally. While we do not think of as a material shock, but any negative delta on oil prices will, of course, affect current account deficit. And if the price shocks were passed on to customers, that may result in higher consumer price inflation as well going forward. So overall, both the whether it's trade negotiation or reducing the oil supply from Russia, both are equally tricky outcomes for India. and of course the two countries are negotiating. We believe that probably India should be able to find some middle ground with the US, which should reduce this impact of these tariffs, as these tariffs really make it unviable for India to compete compared to the rest of the other Asian economies. If you look at the credit growth, although it improved from June, so the headline non-food credit growth improved to 9.7 compared to 9.4 in June, but overall it stays muted compared to last year. If you look at bank credit and the nature of bank credit, industry growth remains quite muted, uh, and in fact, infrastructure growth remains in the negative territory for continuous 3 months. Agri growth also remains quite on the weaker side. So we are seeing, the continuation of the moderation that we saw in retail credit in this quarter as well. So despite RBI removing restrictions or removing the higher risk weights on retail credit has been affected as banks realize that the end consumer is in a slightly difficult position compared to where they were last 12 months due to lower urban spending, and they are also themselves cutting back on retail loans. But if you look at the total flow of credit, especially to the corporates, because of the easy liquidity and because of front-loaded rate cuts today, corporate bonds and commercial papers from many high-quality corporates have become more attractive compared to bank funding. And if we aggregate all the three data, which is commercial paper, corporate bond issuance, and bank credit, for corporate, that has remained at similar levels compared to FY25 as well, year to date. So broadly, we think that while credit growth has come down, but overall we need to see the financial flows to the corporate sector, which also includes your commercial paper as well as the corporate bonds. So overall, in aggregate, that has remained quite healthy. If you look at the trade deficit numbers, they have fallen from 22.22 odd billion from May to 18.8 in June. And if you look at where the fall has come, if you look at the non-oil exports, they have fallen from 33.1 to 30.5 billion. The reason has largely been the front-loaded exports to the US in the first 3 months, which led to a spike, in exports, and which is now normalizing. If we look at oil imports also, as oil prices come down, as economic activity slows down, oil imports have also come down from 20 odd billion dollars in April to now 14 odd billion dollars in the month of June. If we look at the service surplus, services continue to be quite high. So the GCC activity from India continues to remain quite robust, which is resulting in higher services and overall compression in current account deficit. On how the yield curve behaves, so broadly the yield curve remains steep in the month of July 25 as well as we saw in the month of June. So if you look at the two lines of July 25 and June 25, they're almost at similar levels, as a lot of rate cut expectations were already built in post June policy. Largely the market has adjusted to it. So broadly levels have become the the same range as they were in the month of June. So largely we expect curve to steepen further because as market expects a more lower for longer policy in a easy liquidity regime, it will be easier for market participants to take near-term calls and probably invest in shorter-term bonds like 1 to 3 year space, and that should result in a steepening of the curve between 1 to 3, 3 to 5, and so on and so forth. And given that probably at some point of time, market will start to also prepare for policy normalization, there might be resistance from the market participants to invest in very long duration, and market participants will be happy to maintain slightly moderate duration, which should also support bond yields in the moderate duration side. If you look at the movement and credit spread trends broadly, uh, you know, if, if you look especially on the AAA side, yields went down, especially on the 3 and 5 year space, as market participants expected some more dovish stance from the RBI and the August policy. So there was a position build up ahead of the policy. And if you look at even from the credit spreads, and especially AA papers, there was a decent rally in AA papers also in the month of July compared to June. And as market prepares for a lower for longer, we do expect credit spreads to further come down as market participants focus on approval. So to conclude, as we discussed in the first slide itself, the global growth momentum is slowing after the front-loaded strong spending the first quarter of calendar year 2025. So overall, it's constructive for fixed income environment. We do expect global inflation ex of tariffs to weaken and to moderate further down. If you look at India, while rates may remain lower for longer, but we do expect system liquidity to remain substantial and remain above 1% of NDTL, which is about 2.5 lakh. So if liquidity remains quite ample, we do expect overnight rates to trade below the repo rate as monetary policy remains focused on enhancing transmission of previous rate cuts. So if the liquidity remains ample, overnight rates remain below repo rate, it should result in shorter end of the yield curve, looking at further reduction in yield and yield curve further steep. So what we really like in this market is the moderate duration, like we said, is a 2 to 5 year, which is not dependent on rate cuts, but largely dependent on easy liquidity and a stable lower for longer regime. We are also looking at selective credit exposure in well-managed NBFC and corporate issuers in some of our schemes, which are supported by benign funding cost and easy level of system liquidity. We're slightly cautious on long duration because we think that largely rate cut cycle is largely done unless and until growth shocks emerge materially. RBI is unlikely to cut interest rates, and that's why we prefer to stay in the short to moderate rate. So, for investors who have a 12-month investment horizon and an appetite for mark-to-market volatility, they can consider moderate duration products like short-term or corporate bonds, which are mostly invested in the 2 to 5 year segment. Investors who are looking at a 6 to 12 month horizon can benefit from investing in money market or low duration strategies compared to the traditional fixed income schemes or the liquid money market schemes where they can earn slightly better carry. So I'll stop here for now. Thanks a lot for listening in, and now we can open the floor to questions. Thank you.
Thank you, Anurag, for the wonderful insight. Let's open the floor for Q&A. So, Anurag, the first question which I have is that the latest inflation print at 2.1%, which is at a 7 year low, remains well below the RBI's target of 4%, largely driven by sharp moderation in food inflation. However, core inflation has inched up to around 4.4%, indicating underlying pricing pressures. How do you view this divergence between headline and core inflation, and what implications might it have for RBI's policy stance and overall inflation trajectory going forward?
So like we explained in our presentation as well, if you look at core inflation and we strip out the effect of precious metals, which is a gold and silver, which are really not driven by monetary policy, uh, core inflation has also been below 4%. So overall, core inflation is also below RBI target. And since we expect demand to remain softer, we do expect core inflation to remain stable going ahead as well. So while headline inflation may oscillate between below 4 to even above 4 due to the volatile vegetable prices, we expect core inflation to remain close to 4%, X of precious metal prices or other commodity prices which are one-off and which are beyond the monetary policy control. What it means for the RBI policy is, I think RBI is quite clear that that they expect overall inflation, headline inflation, to normalize by Q4 of FY26. They expect inflation to go back to 4% handle in the first half uh, of calendar year 2026. So broadly, we think that given that RBI's mandate is 4% inflation, and if inflation remains around 4%, there is no need for them to cut rates unless and until they are seeing a visible growth shock. So, of course, if they see a strong growth shock, either due to global or local aspects, they will be probably doing more monetary easing. But at the current level of headline inflation, we do not expect them to cut interest rates.
Thank you. So the next question is, despite a cumulative approximately 100 basis points reduction in the repo rate over the last three policy reviews, the transmission to the broader economy appears limited. How do you interpret this trend, and what measures might support more effective pass-through?
So as the governor mentioned yesterday, the transmission actually has been quite effective. It's been around 77 basis in fresh loans, about 81 basis in fresh deposits. Uh, Usually, transmission of monetary policy takes with a lag of 2 to 3 quarters. Given that the last rate cut we saw in June 25, we do expect the full transmission to take place over the course of next couple of quarters. But even we think that even the current transmission is quite effective and quite robust, and it is thanks to the 9 lakh crores plus injection of liquidity by RBI, which has led to the sharp fall in money market rates and even fixed deposits.
Thank you. The next question is, with GST collections trending lower in the recent months, what are your thoughts on the implication for the domestic consumption and overall economic momentum?
So, like we said in our presentation as well, we do think that the growth momentum globally as well as domestically is getting weaker, which is constructive for fixed income environment. So if the growth momentum remains weak, while RBI may not be able to cut interest rate because while it is slowing, it is not slowing to an alarming proportion. But it allows RBI to maintain a lower for longer, rate regime, which gives a certain predictability on interest rates as investors.
Okay. The next question is, India exports nearly USD 80 billion worth of USD goods to the US. Now, in light of recent tariff revisions, how do you assess the potential impact on trade flows and the India's external sector of stability?
Right. So there are two parts to it. One is the sharp slowdown in exports if those tariffs remain affected for a long period of time. Uh, so since India exports more than about 80 billion, and these kind of tariffs, let can result in reduction in exports of about some anywhere between 20 to 25%, which can further impact GDP growth rate. Ceteris paribus, somewhere between 0.2 to 0.5%. That's the first order. As those sectors get more affected, we saw more uh, job losses of those sectors that can further lead to wage price deflation in other sectors. It can lead to overall weakening of confidence channel in consumption, and hence it could be reasonably negative uh, for further improvement in growth trajectory for India over a medium to long term. So yes, if the current tariffs were to hold, probably it will be uh, meaningfully negative for India, not just from exports but from second order impacts as well.
Okay. So the next question is from Mr. Nikun Chheda. The nominal GDP growth as per RBI's latest forecast comes to 9.6%, while government has budgeted revenues at 10.1% nominal growth. Do you think this will result in more borrowings from market or cut in capital expenditures, thereby further slowing growth? What is your estimate for GDP and inflation for FY26 and 27?
So I think given the too many moving parts, especially on the global side, uh, I think it's best to wait for more data to give estimates for FY27. For FY26, we think growth should be in the range of 6.2 to 6.5, and inflation should be close to 3% for FY26. Uh, you know, as far as the slowdown in GST rate and tax collections and meaning for fiscal deficit, we think that the uh, government has the benefit of extra RBI dividend. So probably we don't think government should have any concerns on fiscal. They have enough buffers on spending. They have enough buffers on, non-tax revenue. So we don't think the government will be looking at fiscal expansion just because of the GST collection in this fiscal year.
Yeah, thank you. So the next question is, now FY25 has seen a significant FDI outflows. So what are the key factors driving this trend, and what could be the broader implications for the capital markets and on the INR?
So a lot of investors have been rotating capital from India to other emerging markets, which are undervalued compared to India from a more long period of time. A lot of capital has been rotated from India to even Europe, which is seeing fiscal expansion and probably incrementally stronger growth. We are also seeing some capital going back to the US because of the higher interest rates in the US. And if you look at the interest rates adjusted for currency depreciation in in India, they're actually close to what you are getting in US rates on a unhedged basis. So overall, money is getting rotated from overvalued sectors and to economies which have a higher growth potential. So going ahead, also, I think uh, flows to India will really depend on how our growth potential looks up. Probably the steps taken by the government as well as by the RBI in the last 6 months will help in stabilizing growth expectations for India as well.
Thank you. Uh, you spoke about the credit growth. So one thing what we observed is a sharp decline in the industry and sectoral credit, with personal loans witnessing the steepest drop. So what is your view? What in your view is driving this contraction, and how does it reflect on credit demand and economic sentiment?
Like RBI also mentioned yesterday, because of the easy liquidity, capital market rates are today lower than bank rates for many pockets. So a lot of corporates are switching from bank funding to commercial papers and corporate bonds. So if you combine the three, which is your bank credit plus commercial papers plus corporate bonds, that is very similar to the trends that we saw in last year as well. So from overall aggregate funding to the corporate sector, it remains quite stable. If we incorporate capital market funding as well, which we should, because as the RBI has cut rates aggressively, as RBI has infused liquidity aggressively, the capital market has become quite favorable for many high quality corporates.
Thank you. We'll take one last question, Anurag. Now, while we are, suggesting that we prefer moderate duration exposure, and 2 to 5 year segment is something which investors must look at. Now, within the moderate duration space, there are multiple categories which are there in place, be it short-term corporate bond fund or maybe so float. So now, for how should one, as an investor, one consider which fund should be suitable for him? So what are the factors which one should consider before selecting one of these funds in the moderate duration categories?
So if the investor has a more than 2 year investment horizon, the investor can also look at income plus arbitrage fund category, where the about 35% allocation is towards arbitrage fund, and the balance 65% is between cash and fixed income funds, which is actively managed as per the interest rate view of the fund manager. So that gives investor more flexibility without having any impact on their taxation to be invested in those funds as per the prevailing interest rate cycle. So that is very tax efficient, as well as from an interest rate management perspective, it is quite effective for an investor. If the investor has less than a 24 months investment horizon, but a more than at least a 12 months investment horizon, investor can consider products like a short-term fund, because that is typically run between the duration bands of 1 to 3, or high-quality corporate bond funds, which are also moderately, managed as per duration and have exposure to high-quality corporate bonds, which give accrual to investors without taking too much of a credit risk. So these are the categories that we think that investors could look at, depending on their investment horizon. Of course, if they have less than 6 to 12 months investment horizon, they can consider money market or low duration strategies, because like we are seeing in this monetary policy cycle, we are expecting rates to remain stable. So if you look at the gap between liquid funds to money market funds or money market funds to low duration funds, that has also opened up. So investors have today plethora of choices depending on the investment horizon. So if investor has a very short term immediate liquidity requirement, they can consider liquid funds. But if they can remain invested for 6 months plus, they should consider money market or low duration categories as well.
Thank you. Thank you, Anurag, for sharing the valuable insights and answering all the questions. Thank you, everyone, for joining us today. We trust that the insights shared by Anurag have helped provide a clearer understanding of the current fixed income landscape and the opportunities ahead. We truly appreciate your next event. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.